Hi, I'm Pete Andresen with Andresen & Associates, and this is your quarterly review ending in September 30th, 2024. Those 3 months, July, August, and September of 2024. A lot happened, but to really understand it, I want to go back to an earlier time. And frankly, a surprising number of my clients have been there with me. Let's go back to December 31st, 1999. Anybody remember what that looked like? What did that look like? Well, we had a superb Republican president, Bill Clinton, and that's a bit of a joke, but seriously, we ran a governmental surplus. We had the quote-unquote peace dividend, but most of all, we had the dot-com bubble going on. The big thing there is that from 1995 until March 10th, 2020, internet stocks went on a complete binge, and the reason for that was genuine, and that is that internet was transforming and going to transform the world. And it did, didn't it? Looking back, we can see that the internet absolutely radically, for better or for worse, changed the way human beings operate in the world. Now, we had a bit of irrational exuberance, as it was called, going on, and valuations got really stretched. But basically, in the preceding year, and the preceding 5 years, and the preceding decade, to December 31st, 1999, technology dominated completely. You had a lot of companies that didn't have any earnings. In fact, they were going IPO, public offering, and they were basically shell companies that had nothing to offer. But that was the internet craze. And so if you were an investor on December 31st, 1999, you would be thinking really deeply about investing completely in technology. In fact, I had clients who fired me in the late 1990s because I did not go 100% in technology. And they took their money out and put it into technology. If you wanted to invest in what were called the old economy stocks, then you were a bit of a FUD. The Federal Reserve realized, in fact, the term irrational exuberance comes from the chairman of the Fed at the time, who said, this is getting out of hand. So they raised interest rates going into 1998, 1999. What could go wrong? Okay. Stay tuned and let's see what happens next. You're an investor, December 31st, 1999. Let's go up to Tahoe and think about that. Well, there we are, December 31st, 1999. Technology has romped. The Federal Reserve has tried to cut back the irrational exuberation by raising interest rates. Sound familiar? All of a sudden, technology companies cannot produce the earnings. Because remember, most of the dot-com bubble was due to companies that didn't even have earnings. Remember that? Remember Pets.com? So March 10th, 2000 was the high water mark for the NASDAQ. And then it started to fall. And that fall built on itself until technology had lost a whole bunch. If you were going through that, bonds didn't lose a lot of money. In fact, they went up. Old economy stocks, as they were called, actually went up. The Federal Reserve cut interest rates to an abnormally low level to save people from themselves. And that produced another irrational bubble in mortgages, which led to the mortgage meltdown, the financial panic of 2008. So a rule here, irrational exuberance is a normal thing at market extremes in both directions. 2008, Remember, we have the war on terror going. Stock market crashes again and crashes hard. And this time everything goes. Banks, cement companies, all the stuff that didn't go in the dot-com bubble went in 2008. What ends up happening, look at this graph. What ends up happening is that decade, there was such financial insecurity that gold, which is correlated to lower interest rates, finished $10,000, became $105,000. Van Eck, that mutual fund we don't use because GLD came from the same company. First Eagle Global International did $10,000, became $37,000 in a decade. Vanguard Total Bond Market Index, which is actually less protective than the longer term bonds we're in, actually made $10,000 into $19,000. But here's the biggie. The Schwab S&P 500 index at one point was down 50% during the decade and finished the decade with essentially neutral. $10,000 became $10,400. 10 years of nothing, nada. Think about the clients beating on my head about that. The QQQ, the NASDAQ, the technology stocks finished that decade. $10,000 became $6,000. It was a dreadful decade. And at the end of that decade, now there you are. It is now 10 years later. It's December 31st, 2010. What are you going to invest in? Gold, of course. You're going to buy gold. Gold has been going up. You're going to buy lots and lots and lots of gold. You're going to stay away from tech because that's what the last decade looked like. But what's overvalued? Wait till you hear the rest of the story. I'll be seeking consolation. So there you are. You're an investor on December 31st, 2010. What are you going to invest in? Gold has absolutely run the board in the last decade. Technology has sucked. Stock market is Bonds have done decently, but not great. Bonds never do great. Well, they rarely do great. So what are you going to put your money in? You're probably going to put your money in gold if you're a normal investor. And that's what a lot of people did. Remember, gold is also very, very volatile. There you go. That's the word I'm looking for. Gold is volatile, and it also is hard to price because it has no earnings. It's a sterile investment. So there you are in December 2010 looking at the fire. So what happened in the next decade? Take a look at this graph. Yeah, Merry Christmas. Okay. Guess what? Technology kind of putzed around until 2017, and then AI came along, artificial intelligence, and that really rocked it. Invesco QQQ Trust is our proxy here for technology, and it absolutely rocked up. $10,000 became $63,000 in 10 years, and the Schwab S&P 500 index, which as always floats and modifies to shapeshifts, you could say, to whatever is making the most money, became a tech-dominated index and did $10,000 became $36,000. Vanguard Wellesley, which was both bonds and stocks, remember 60% bonds, 40% stocks, doubled in 10 years. Followed closely thereafter by First Eagle, which did not produce the absolute monster performance. It produced an okay performance, but not a giant performance. Meanwhile, bonds, $10,000 became $14,000, and that was because interest rates stayed low pretty much through the entire time. In fact, we stayed in those 6,000-year interest rate lows. They were still producing negative interest rate bonds in Europe and Asia. It was a low interest rate environment through most of that decade. And at the bottom, and this is important, was the very investment that had shot the lights out the decade before, gold. We're using the Van Eck International Investors Gold Fund to replicate that. And at one point, gold was down 50% from its high, and on an inflation-adjusted basis, it still has not recovered from its losses. So anyway, $10,000 became $7,353. So there you are. And now it's December 31st, 2020. We've gotten through COVID, which was completely bailed out by the Fed. And remember, anytime the Fed or any other entity alters the interest rate and the money supply substantially, something will happen. There will be a reaction. And also remember that valuations matter. Okay, it's December 31st, 2020, and you're in isolation with your mask on, and you're deciding where to invest next. Where are you going to invest? Let's see what happens. So it's December 31st, 2020. Here's what's going to happen in the next 4 years. Remember, we had an economic shutdown in 2020. The Federal Reserve pounded it with money. The money supply grew. Basically, we had helicopter money. Interest rates went to all-time lows. Those European and Asian negative interest rate bonds were the thing. So interest rates were essentially zero. But here's what happened, because remember the rule, when money supply changes and interest rates change, there are consequences. There's always consequences. In this case, it was inflation. Take a look at this graph. That's inflation. As you can see, it's coming down, but it certainly spiked. Now look at this graph. This is the last 4 years from December 31st, 2020. And as you can see, inflation hit, the interest rate was raised by the Federal Reserve, and the result was the worst bond market in history, or at least in the modern era. Long treasuries fell 50%. Those negative interest rate bonds were slaughtered. It was a chaotic mess. So, in the last 4 years, you've seen the absolute vanquishing of lower interest rates. You've seen the absolute destruction of the bond market. By the way, at the bottom of the bond market, we did some buying. That's what you saw. Another thing happened, though. When the Federal Reserve raised interest rates and bonds tanked, very quickly the perception came about that tech will save us all, and AI in particular is going to save us. So AI spiked. Remember that old thing I keep bringing back, valuation, valuation, valuation. We're already at near historic highs. We're already at the level we were in the dot-com bust in 2000. Now, people will say this time is different, but this time probably isn't different if you look at what I've showed you. Basically, what made money was, as you can see in the graph, the S&P 500, because it's dominated by 10 stocks. Take a look at this graph. As you can see, this is a Russell index, but it's essentially the same. The indexes are now dominated by the AI stocks. They've absolutely gone ballistic. The QQQ, that's the NASDAQ, went up almost as much. But here's a surprise contender. It hasn't caught all the way up, but here comes gold. Gold is spiking. Why is gold spiking? Not because of inflation, not because of rising interest rates. It's because of the concern about governmental chaos. I suppose there's an element of rising interest rates in there because they see the loss of control going on. So gold is spiking as well. And remember, gold is notoriously hard to value because it doesn't have any earnings. So right now, that's what we're looking at. Now, take a look at the last 2 years. Here's the last 2 years. Look at that. It's fascinating, isn't it? We've got another bubble on our hands, another technology bubble. This time it's not pets.com, it's AI. So if we're at all-time high valuations, we're not, but we're close. We have to start becoming concerned. And what's inexpensive? What's inexpensive is small stocks and internationals. So how are those working out now that we've bought them? Here's a graph of the last quarter. Check this out. At the top we have gold. It's on a run, like I said. Gold is a fear trade. Gold is a trade that people do when they're uncertain. Because, as I said, it cannot be valued, and it's a sterile asset. It doesn't produce anything, doesn't make anything. But it's great to have if the economy completely blows up or there's social unrest and you want to carry it from one place to another. It reasonably keeps up with inflation, but it's not really an inflation trade. Next, you can see, astonishingly, we've got First Eagle. Those undervalued international stocks are coming in. And this is in the last 3 months. This is in your portfolio. We've got the old economy stocks, those FUD stocks in Vanguard Wellesley. And finally, we've got, well, not finally, but you can see we've got the S&P 500 followed shortly by the Treasury bonds. Treasuries actually are starting to come back up after we bought them inexpensively. They're coming back up because interest rates appear to be declining. The Federal Reserve said they were going to lower interest rates, but mostly it's been a head fake since then. It's the long bonds that concern us with this chart. And finally, look at the back end, the tech stocks. Now, are we seeing a top? I mean, they didn't go down, but they stalled. Or are we seeing just a short rest? We don't know. Remember, valuations don't lie, but they don't do very well at predicting. A tech bull market could go on for years and years and years and then end quietly or blow up. Most of the time they blow up. Overvalued investments do. Because remember, one of the rules is that markets always go to irrational extremes, and that seems to be happening here as well. So, at any rate, it was a doggone fine quarter for us at Andration and Associates, and our diversified portfolio finally began to generate some money in the face of that AI. So thank you for sticking with me for this very long video. Yes, I know I pulled the graph in a little bit early. Thanks for pushing through this with me. This explains what was in your portfolio. I have one last question, and that is this. You've seen how investments spike up and then decline, and spike up and then decline. Right now, one way I'm coping with that is by not rebalancing your S&P 500 or your tech investments. My perception is that in the long run, two things are going to happen. Number one, you're going to experience a little more pain when the decline finally hits. Number two, if you can ride with it and even buy more, in the long run, you'll be rewarded. Let me know what you think, because we are adding risk to the portfolio by allowing those things to go unbalanced. So, thank you very much. Have a great day, and blessings.